Hello everybody, this is Rudra Pradhan here. Welcome to BMD lecture series. Today we will continue with the decision analytics, and that too in the last class we have discussed about the kind of requirement, the kind of criteria through which we can address a business problems and then come with a kind of management decision as per the particular requirement. In fact, we have discussed several techniques, in fact the kind of tools through which we can come with a kind of outcome through which the decision making process can be very effective, and that too as per the particular business requirement or the kind of problem requirement. So, technically we have discussed couple of criteria like average Payoff criteria, maximax Payoff criteria, maximin Payoff criteria, average Payoff criteria, and minimax regret criteria. So, that means corresponding to a kind of problems, we have kind of possible outcomes depending upon the various alternatives and the kind of strategy. So, we have a payoff matrix where the possible outcomes are there corresponding to alternatives and the kind of different strategies. So, the idea is which particular outcome can be finally picked up for the decision making process or to address the problems as per the particular objective or the particular requirement. So, we have already discussed all these tools, and we have also connected with a particular problems through which we can get to know that how these techniques can be used to pick up a particular outcome, that means the best outcome through which we can come with a kind of management decision. So, now in order to elaborate more about these techniques, let us take another examples and then we can highlight this particular issue. So, here the typical problem is we have a kind of financial instruments, and here there are 4 different financial instruments: stocks, bonds, CDs, then the kind of mixture, that the combination. And then so far as a business environment is concerned, so we have a three different ups and downs, the stagnant, slow growth and rapid growth. Compared to last examples, we have a increasing trend, stability and decreasing trend. So, here in the similar fashion we have 3 different structure. So, where the outcome can be predicted or can be generated, and that too with 4 different options or alternatives. So, that means, in the case of stocks, what should be the possible outcomes against stagnant, slow growth and rapid growth. Against through bonds, what is the outcome with respect to stagnant, slow growth and rapid growth. Likewise, for CDs and mixtures. So, we have altogether 4 into 3 different levels of outcome to address the particular problem. So, that means, it is a kind of decision making process for the investors, for any kind of financial investment, what should be the typical output corresponding to different economic situations like stagnant, slow growth and rapid growth. So, likewise, it is the question of the annual payoffs for an investment of $10,000, and then this is how the predicted outcome matrix or payoff matrix through which possible outcomes are there with respect to different instrument and different economic conditions. So, what is the best predicted output through which you can actually address this business problem. So, now we can start with simple structure. So, the criteria which you have discussed earlier is business condition under certainty, business condition under uncertainty and business condition under the risk scenario. So, that means we have a 3 different structure of the business environment. So, corresponding to these instruments, financial instrument and the kind of economic conditions, we have the payoff matrix, and then we like to check what should be the possible outcome in the kind of business where there is a situation of certainty, and then same matrix we can use under the business environment where the things are uncertain, and then we like to analyze the same problems under the condition where there is lots of risk involvement. So, now under this certainty the case is that all these things are known to us. So, as a result what should be the best outcome within the particular structure, and corresponding to this particular structure. So, we have actually what we have discussed. So, these are all kind of outcomes. So, we have a stock, we have stocks, we have bonds, and we have CDs, then the mixture. So, there are 3 different output levels corresponding to the economic scenario. So, stagnant, slow growth and rapid growth. So, we have a outcome corresponding to each case. So, that means in the case of stagnant, the behavior stock, bonds and CDs represents in this column, and similarly for in the case of slow growth, this is the possible outcomes corresponding all these financial instruments. Again, for rapid growth, these are the possible outcomes under the 5 financial instruments. So, now since it is a kind of investment, so what should be the possible outcome? So, that means the typical structure of investment is, if you put like money, so what should be the returns or the kind of outcome. So, obviously, we are expecting maximum. So, if everything is certain, so then out of all these outputs starting with 500, then ends with 300. So, that means the first output where the condition is the stagnant, and that to first instrument stocks. So, it is of 500, and the last is the mixtures, and that is with respect to rapid growth, that is 300. So, obviously, so the typical structure is that in the case of kind of a requirement. So, the best strategy will be the case of stocks, and that too in the case of rapid growth, because it is the highest outcome corresponding to all possible outcomes in this particular matrix. So, this is how the simple decision which you can have here to analyze this problem. So, that means the objective of this problem is, if you like to put some kind of investment, what is the possible returns under different situation under different financial instrument. So, now having all these financial instruments and different economic condition, we have possible outcomes, and out of all these outcomes, so 2200 is the best outcome where it is generated through stocks, and that too in the case of rapid economic growth. So, that means the particular behavior of stock can vary with respect to economic conditions, in the case of stagnant, in the case of slow growth, and in the case of rapid growth. If you analyze this particular row, so that means stocks can contribute or can give you the outcome of $500 with respect to 1000 investment, which we have highlighted earlier. So, then in the case of stagnant, so it will be $500, then in the case of slow growth, it will be no outcomes, that is 0, and then in the case of rapid growth, it is 2200. So, as a result, so this is the best outcome corresponding to other instruments and corresponding to means other instrument with respect to all these economic conditions. And by the way, so these are the typical issues through which you can derive under the business where it is everything is certain, and then we will like to know how is the kind of decisions in the case of uncertain situation. So, in that case we have discussed couple of techniques starting with maximax criterion. So, in this case what is the structure. So, we have the same kind of matrix. So, here against these 4 instruments and these 3 economic conditions, and then so the according to this criteria. So, against stock we have to find out which one is the maximum outcome. So, that means we have 500, 700 and 200. So, then in this case, so the possible outcomes will be 2200, that is the maximum one. Similarly, in the case of bonds, so the maximum out of 100, 600, 900 is 900, and similarly for CDs, so the maximum outcome is this 750, and again in the case of mixture, so it is the maximum outcome is 1300. So, out of 200 and 650. So, that means technically all the financial instruments against each economic conditions generate maximum of 2200, 900, 750 and 1300. Again, if you go by this maximax criterion, so we have to find out which one is the maximum among these among these four maximum case against stocks, bonds, CDs and mixture. So, obviously, so the best choice is the 2200. So, like in the case of certain, so in the case of uncertainty business environment where maximax criterion also gives the same output, that is 2200, and that is happening in the case of stocks, and that too in the business environment where there is a signal of rapid economic growth. So, again come to the kind of second case, that is the criteria of max mean. So, in this case we have to find out the minimum against all the financial instruments, and that too with respect to three business business conditions, that is the stagnant, slow growth and rapid growth. So, in the case of stocks, out of 500, 700 to 2200. So, the minimum one is the 500, and then again in the case of bonds the minimum one is 100, and in the case of CD the minimum one is 300, and in the case of mixture, so it is 200. So, as a result, if we summarize, then so 500, 100, 300 and 200, but our criteria is max mean. So, that means technically, so we like to find out now. So, what is the minimum of all these kind of requirement. So, that means technically what is the maximum numbers out of these minimum conditions. So, that is what actually 500, and if it is mean criterion, then this will be 300. So, this is how the kind of structure which you can derive in the case of max mean criteria, max criterion, and and that to generate a kind of outcome through which you can address this particular investment decision. And the other criterion here is to find out the kind of structure through which in this particular criterions we have little bit complexity, but it is very interesting to reach the conclusions and to draw the kind of outcomes which can address the investment decision more accurately and more effectively. So, in this case we have actually a same kind of matrix, input matrix, that is the payoff matrix. And what will it do? So, in the previous case we try to find out the maximum one first, then we try to find out the minimum one first, and we look for the maximum, or in the case of minimum. So, what will it do in this case? We can just club these two criterion. So, what will it do? So, against stocks we find out what is the maximum returns and again what is the minimum return. So, out of these three, so 2200 is the maximum and 500 is the minimum, and in the case of bonds 900 is the maximum and 100 is the minimum. In the case of CDs, so 750 is the maximum and 300 is minimum. Similarly, in the case of a mixture, 1300 is the maximum and minimum is 200. So, now what will it do actually? So, we try to find out the maximum among all these financial instruments and minimum among all the financial instruments with respect to all these three economic conditions, and having maximum and minimum. So, in this criterion what will it do? We try to find out weighted average of maximum and minimum of these outcomes against stocks, bonds, CDs and mixture. So, what will it do? We like to apply first weight. So, the corresponding weight will in such a way that the total probability will be exactly equal to 1. So, that means technically if we start with let us say alpha equal to 0.7, then obviously the 1 minus alpha will be 0.3. So, as a result, so alpha plus 1 minus alpha is equal to 1. So, this is actually means we like to extract what is the weight against the maximum or what is the weight against the minimum, and we try to have weight in such a way. So, there is some kind of difference, otherwise it will be equal weightage and there is no point to club differently. So, in this case having this weight alpha equal to 0.7 and 1 minus alpha 0.3, which apply in the case of minimum, and alpha equal to 0.7 which apply in the case of maximum. So, as a result, so the weighted average is in the case of stock will be 1390, then against bond 600 and against CD is 615, and then under mixture it is 850. So, that means technically the process to have these figures are like this. So, it is 0.7 into 2200 plus 0.3 into 500, that will give you 1390, and against 0.7 into 900 plus 0.3 into 100, it can give 600. Likewise, you can have value for CDs, that is 615, and the value of mixture, that is 850. So, now we like to pick up which one is the best depending upon maximum criteria or minimum criteria. If we apply maximum criteria, then this will be the final outcome and this is the best decision. If it is the minimum criteria, then this will be the best kind of decision. Since it is a investment, we are expecting more return. So, the maximum choice is the right kind of indication. So, as a result, so this is the best outcome through which this financial investment can be more effective to address this business problem. So, now corresponding to these criterion, so we can a little bit highlight more about these ones. So, for that what will we do? It is the game between actually alpha and 1 minus alpha. For that we have already discussed here by fixing alpha equal to 0.7 and alpha equal to 1 minus alpha equal to 0.3. So, that means if you change the alpha value less than 0.07 or more than 0.7, then obviously 1 minus alpha value will also change. So, it can go maximum to 1, and if it is 1, then minimum by default will be 0, the weight for minimum will be 0, and if it is actually 0, then the minimum means weight for the minimum one is the 1. So, we try to have weights in such a way it should not be 0 and 1 case, it should be in between. So, that the kind of requirement is can be more visualized and the decision can be more effective, and for that we try to start with alpha 0.0, 0.1, and then finally it will be 1.0. So, that means this is the kind of alpha value. So, this is the minimum and this is the maximum. When it is the minimum, that is the 0.0, that is one extreme. So, in that case 1 minus alpha equal to 1.0. So, when alpha equal to 1.0, then by default this will be 0.0. So, now having alpha and 1 minus alpha. So, we have a case of stocks, we have a case of bonds, we have a case of CDs, and we have a case of mixtures, and in each case we have already actually derived the kind of maximum and minimum. So, we have to just report maximum and minimum against all financial instruments, and then try to find out the kind of weight means weighted average. So, that means technically, so this is here 0.0 into 2200, then plus 1.0 into minus 500. So, this will give you minus 500, and again so 0.1 into 2200 plus 0.9 into minus 500. So, it will give you minus 2.30 like this. So, we can have also for bonds, and we have also a case of CDs, and we have a case of mixture. Then corresponding to change of alpha, we have change of 1 minus alpha, and accordingly the value of the means the weighted outcome against stocks, bonds and CDs and mixtures are available corresponding to each alpha entry starting with 0.0 to 1.0. So, that means we have again plenty of options or plenty of flexibility to pick up a kind of outcome through which we can address the business problem or investment decision more effectively, more accurately and more efficiently. So, that means it is a kind of interesting criteria through which you can address this business problem, and for that this particular tools, this particular tools can give you better indications through which you can address this business problem. So, in sum, this is a fantastic analytic tool through which we can take we can come to a kind of decision which is more effective, more practical and kind of best for the particular problem. So, now corresponding to these examples, and then again we have the kind of structure here. So, that means technically if you apply this alpha change and then against stocks, bonds and CD and mixtures. So, if you plot, because it is now generated a series. So, starting with alpha variations. So, what is the expected outcome against stocks, bonds and CDs and mixture. So, we can actually graphically plot and then we can get to know how is this particular structures. The moment we will put here actually alpha. So, by default we can get the 1 minus alpha. So, then we can have the weighted average between maximum and minimum, and that too having the alpha value and 1 minus alpha. So, now if you put, so the overall structure is that in the stock, that is the financial instrument is highly effective, or it is a kind of produce best outcome for this financial investment compared to the outcome received from CDs, bonds and mixture. In fact, mixtures it is little bit above the in comparison to bonds and CDs, but slightly lower to stocks outcome or stocks return. So, that means it is a kind of effective environment or effective decision making process through which you can actually address this problem and come with a kind of outcome which can give you better kind of judgment to think about it and to address these problems as per the particular business requirement. So, then the last technique which we have already discussed. So, that is again having payoff matrix. So, what will you do? We like to extract actually the minimum among each column. So, that means technically. So, here the minimum is 200, then this is minimum here is 500 and minimum is here is 750. So, now this 200 will be subtracted against all instruments, and that too under stagnant, against slow growth and the rapid growth. So, that means to the series will be the entire payoff matrix will be now transferred to 500 minus 200, 100 minus 200, 300 minus 200 and 200 minus 200. Similarly, in the case of slow growth, 700 minus 500, 600 minus 500, 500 minus 500, again 650 minus 500. Like this you can also have in the case of rapid growth. Then finally, so the structure will be transferred into like this, and this is what the intermediate payoff matrix. Again we like to find out the the kind of opportunity loss, and that too we have to again what will we do, find out the maximum against stocks, bonds and CDs and mixture, and that too derived from the opportunity loss tables that is actually obtained from the original payoff matrix by subtracting the minimum payoff from the stagnant case, slow growth case and rapid growth case. So, as a result, so we have this particular matrix finally, and again depending upon the criteria. So, we like to find out maximum among these particular financial instruments, and then finally we have to find out what is the minimum against all these maximum. So, obviously, in this case, so 800 is the maximum case, and that too the case of the case for stocks, and again 1300 against the case of bonds. Similarly, for 1450 in the case of CDs, and again 900 in the case of mixture. So, now we have to find out the minimum among these 4 maximums. So, by default 800 is the best choice for this criteria, and that to address this financial decision against stocks, bonds, CDs and mixture, and that too under 3 different economic scenarios, that is stagnant, slow growth and rapid growth. So, likewise likewise we can have similar kind of problems, and we can apply all these techniques or the criterion through which you can come with a kind of best outcome through which you can address the business problem more effectively as per the particular business requirement. And in fact, if we like to summarize, so what I have mentioned, the strategy and objective can be minimize objective, can be maximize objective, and then we have a different kind of criteria, starting with average payoff, and then the kind of aggressive strategy, the conservative strategy, that is minimax criteria, then opportunity loss strategy. So, so this is what the kind of environment. So, the first part is with respect to minimization of objective functions, and the second one is the maximization of objective functions, but you can apply different criteria starting with average payoff, aggressive strategy and conservative strategy. Then accordingly we can find out the best outcome from the payoff matrix that is obtained through the possible alternatives and different kind of business environments. And so, decision making process is a very interesting kind of situation through which or the kind of toolbox through which actually you can pick up a best outcomes as per the particular business requirement or the kind of problem requirement. So, with this we can move to the kind of component what is called as decision tree. So, that means whatever criteria which you have already discussed against a particular business problems, depending upon the number of alternatives, number of strategy, we have seen there is a possibility of to bring a kind of optimality structure, where we have different kind of outcomes, and through a particular technique we have to find out, or we have to choose a best outcome through which you can address the business problem more effectively, and that too as per the particular requirement. So, now the same things we can actually analyze, and that too the game with kind of concept called as decision trees. And so, that means the concept decision tree is like it is a kind of branch and bound structure. So, that means it is like branching, or it is a kind of toolbox, or it will give you a kind of flow chart through which the same problems can be correctly recognized and correctly specified, and through which you can visualize, and then you can pick up a particular structure as per the particular business requirement. So, that means so the decision tree can be designed corresponding to the particular alternatives and the different strategy through which the payoff matrix can generate the outcomes, and then decision tree will give you the some kind of accuracy and to give the kind of clarity through which the decision making process will be more effective. So, what is the concept of decision tree altogether? So, this consists of nodes and branches and that are useful approach to structuring the decision problems where there is a involvement of uncertainty, and the nodes are typically the points in time at which events takes place, and decision nodes are nodes in which decision takes place by choosing among several alternatives, Event nodes are nodes which an event occurs not controlled by the decision maker typical. So, that means technically, so it is the kind of structure through which all these possible outcomes against alternatives and different strategy can be correctly specified, and the visualization and specification can give you better kind of judgment, or give you a kind of clear cut understanding to the decision makers, so that one can pick up a best strategy or best outcome through which you can address the business problem more effectively. So, that means technically, so this is the effective tool through which you can actually address the business problem more accurately as per the particular problem requirement. So, so far as the solution is concerned, we have already highlighted in a kind of situations. The first step of the process is to find out payoff metrics corresponding to alternatives and different kind of business environment or the kind of strategy. Then after having the complete payoff matrix, which may not be by default in a kind of structured format. Of course, by applying some kind of criteria, we can pick up the best outcomes out of all possible outcomes in the payoff matrix, and that best outcomes can address the business problem more effectively, and come to a conclusion that decision makers can effectively apply the particular outcome to highlight the problem or to address the business problem. So, decision tree again help you, or help us to get the kind of similar kind of structure. So, that means having more all such possible outcomes, it will give you some kind of structured it's kind of like path diagram type situation through which you can correctly visualize that this is how the possible outcomes against all alternatives and the kind of different strategy, and then you can actually correctly pick up a particular one as per the best requirement or the kind of management requirement. So, typically the decision making process is like this. We can actually use risk solver package in the Excel, through which actually we can actually get this decision tree. So, that means the outcome which you have already, and the kind of choice or the kind of the payoff matrix all are there, but it will just use these criteria and have the payoff matrix, then decision tree will give you more kind of accuracy to understand the particular situations, and then pick up a particular outcome as per the best decisions or as per the best requirement. So, now so this is how the risk solver structure through which you can come into the kind of conclusion. And to understand the particular structure, we can come with a kind of examples which we have already discussed. So, again this is a kind of financial decision. So, we have a 3 different alternatives, 1 year ARM, 3 year ARM, 30 year fixed, and then against we have increasing rate, stable rate and decreasing rate, and that too we have a probability. The probability is 0.6 against increasing rate, stable case 0.3 and against decreasing it is 0.1, and if you add up this probability it is coming exactly equal to 1. So, this must be satisfied because it the particular matrix is in the form of a kind of probability structures. As a result, whatever outcomes will be theirs, and when we connect with a kind of weight, so that must be consistent and must be satisfied. Otherwise, the particular predictions and the kind of decision making process will not be correct ones. As a result, so the choice of a particular outcome to address the business problem may not be very accurate. So, that there is a problems for the decision makers to pick up a particular outcome and to address the business problem more effectively. So, it is obviously, let us say, so this is the case, and the typical structure will be like this. So, that means technically, so the process will be like this. So, let us say we start with a kind of decision making process. So, like the example which you have already highlighted. So, it is the 3 different situation altogether, and then against three different situations we like to find out what are the possible alternatives again. So, like this you have a find out various alternatives again. So, that means we have actually 3 into 3 kind of structure, and this is a kind of path diagram. It is not exactly the decision tree, but it is a kind of path diagram which can give you the indication that within a 3 kind of alternatives and with a 3 different strategies. So, we can have altogether 9 different outcomes, starting with this one, then the second, third, fourth, fifth, sixth, 7, 8, 9. So, this is how the kind of an outcome which you can have, but when we have a similar the kind of outputs corresponding to all these flexibility and different strategy. So, we can prepare a decision tree which can give you correct specification, correct understanding, correct visualization, so that the investors or decision makers can visualize properly, understand the reality, and then address the problems as per the particular requirement. To know more about this, what we can do? So, let us start with like this. So, this is what the starting. So, obviously, we have a 3 different option altogether. So, this is the first option, this is the second options, and this is the third option. So, 1 year, 3 year and 30 year fixed. So, that is how the 3 different alternatives we have, and against each alternatives we have a 3 different outcomes. So, this could be the kind of outcomes. So, like this. So, against this could be the final outcome, and then this could be the another outcomes, against this could be the outcomes, and then this could be the outcome. So, this is how. So, the node can be closed here, node can be closed here, node can be closed here, and this can be closed here, 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 this can be closed here. So, now that means technically the problem which you have already highlighted. Whatever outcomes we have corresponding to all these 3 alternatives against 3 different situations. So, ultimately we have a 3 different means 9 different outcomes, and decision tree give you more such more kind of effective structure, and the same payoff matrix can be visualized correctly and understand correctly as per the particular investment requirement. So, if you talk about the decision tree, so this will be the kind of like it is a kind of branching problem, and the kind of path diagram through which you can address the business problems as per the particular requirement, and that too under various alternatives and under various different strategies, and then we have to pick up the best ones as per the particular requirement. It's it is like branch and BBM, branch and bound mechanisms, which you have already discussed in the case of prescriptive analytics, in the case of linear programming problem. So, it is also similar kind of structure. So, the idea is having all strategy and different economic situations or different kind of strategy, we have possible outcomes, and these outcomes should be properly structured, and then every possible outcomes can be evaluated, and then with every possible outcomes can be the typical item which can address the business problem, but out of all these possible outcomes we have to pick up a best outcome which can visualize the business problem more effectively. And of course, to pick up a particular best outcome, we have to apply a particular criteria through which you can address this business problem more accurately. And with this we will stop here. Thank you very much.